Are you worried about the possibility of losing your hard-earned money in today's volatile economy? With so much uncertainty, it's understandable to feel hesitant about investing your money in anything that doesn't guarantee a safe and high-yield return. But what if we told you that there are affordable assets that can make you rich by 2025? That's where Robert Kiyosaki, a successful author, investor, and businessman, comes in. Kiyosaki has dedicated his career to educating people on how to achieve financial freedom through smart investments. In this video, we'll delve into Kiyosaki's expert investment strategies and explore the affordable assets he believes can provide substantial returns without exposing you to unnecessary risk. With the world economy facing an impending catastrophe that experts predict will occur by the end of 2023, it's essential to secure your financial structure now more than ever. Join us as we learn from the best and discover how these affordable assets can help you achieve financial success by 2025 with Robert Kiyosaki. The current economic situation is marked by some of the most challenging headwinds since World War II. The global economy has been grappling with a series of significant challenges, including the COVID-19 pandemic, geopolitical tensions, supply chain disruptions, and inflationary pressures. These combined factors have created an environment of uncertainty and volatility, impacting various sectors and economies worldwide. The Federal Reserve, commonly known as the Fed, plays a crucial role in shaping the economic landscape of the United States. One of its primary responsibilities is setting interest rates. The Fed's monetary policy decisions aim to maintain price stability, support economic growth, and ensure financial stability. Recent rate hikes have been implemented as a response to rising inflation and signs of economic recovery, with the Fed gradually tightening its monetary stance. Renowned author and investor Robert Kiyosaki has been critical of the Federal Reserve's approach to interest rates. He argues that the Fed's policies have contributed to a distorted market environment characterized by artificial asset inflation and widening wealth inequality. Kiyosaki suggests that the low interest rate environment, combined with quantitative easing measures, has primarily benefited the wealthy, while leaving the middle class and working class at a disadvantage. Kiyosaki predicts potential consequences resulting from the Fed's approach. He expresses concerns about a possible market correction or crash, emphasizing the risks associated with an inflated asset bubble. Kiyosaki believes that the Fed's interventions have distorted market fundamentals, and he warns of the dangers of excessive debt and speculative investing. He encourages individuals to be vigilant and prepared for potential market disruptions. The current economic situation has the potential to impact various sectors. In the equities market, the risk of a market correction or crash may lead to declining stock prices and increased volatility. Investors need to carefully assess their portfolios and consider strategies to manage potential risks and capitalize on opportunities during these uncertain times. Do you dream of living a debt-free life and taking control of your financial future? Well, it's time to take the first step towards making that dream a reality. Just hit that subscribe button and turn on the notifications bell so you can start receiving regular updates and helpful tips from our videos. Real estate is another sector that may be affected by the current economic situation. Higher interest rates can result in increased borrowing costs, potentially impacting housing affordability and dampening demand. This could lead to a slowdown in the real estate market and put downward pressure on property prices. Additionally, the current economic situation can influence the value of the US dollar. Interest rate differentials between countries can impact currency exchange rates. As the Fed tightens its monetary policy with higher interest rates, it may strengthen the US dollar compared to other currencies. This can have implications for international trade, export competitiveness, and the cost of imported goods. The derivatives market could also face significant impacts due to the current economic situation. Derivatives are financial instruments whose value is derived from an underlying asset or benchmark. Increased volatility and uncertainty can amplify risks associated with derivatives, potentially leading to higher market volatility and increased losses for investors. Central banks play a pivotal role in the functioning of modern economies. One perspective on central banks, shared by renowned author and investor Robert Kiyosaki, is that their primary purpose is to manipulate and control the money supply to influence economic outcomes. Kiyosaki believes that central banks have significant power and influence over the financial system, and their actions can have far-reaching consequences. Kiyosaki has expressed his disagreement with Joe Biden's claim about bank rescues. He believes that bailing out banks using taxpayer money sets a dangerous precedent and undermines the principles of a free market economy. Kiyosaki argues that these rescues perpetuate a system where banks take excessive risks, knowing they will be saved by government intervention. He advocates for a more responsible and accountable banking system that allows market forces to determine winners and losers. Inflation is a topic of concern for Kiyosaki, and he worries about the potential for more money printing by central banks. When central banks increase the money supply through mechanisms like quantitative easing, Kiyosaki believes it leads to a devaluation of the currency and a rise in inflationary pressures. He sees this as a hidden tax on the middle class and a threat to people's purchasing power. Kiyosaki encourages individuals to be proactive in protecting their wealth by investing in assets that can withstand the erosion of value caused by inflation. Moreover, Kiyosaki's concerns about inflation are rooted in the belief that excessive money printing, without corresponding increases in real productivity and output, can lead to economic imbalances and financial instability. He warns that if central banks continue to print money without restraint, it could result in asset bubbles and speculative excesses that are ultimately unsustainable. Kiyosaki argues that these actions can distort market fundamentals and create a false sense of prosperity, potentially leading to severe economic downturns. The decisions made by the Federal Reserve regarding interest rates have a significant impact on personal finances. One area where individuals can see the influence of the Fed rate is on their savings accounts and certificates of deposit, CDs. When the Fed raises interest rates, it often leads to higher yields on savings accounts and CDs. This means that savers can earn more on their deposits, which is especially beneficial for those looking to grow their savings over time. Rising interest rates also have implications for mortgage prices and home buyers. When interest rates go up, borrowing costs increase, which can lead to higher mortgage rates. This means that prospective home buyers may face higher monthly mortgage payments, potentially impacting their affordability. Additionally, rising interest rates can slow down the housing market as fewer people can afford to buy homes. According to the National Bank Rate statistics, the average savings interest rate has increased from 0.06% to 0.23% over the past year, as of May 2023. This rise in interest rates can have implications for various financial aspects, including mortgage prices. When there are indications of a rate increase, borrowers may feel compelled to expedite the process of finalizing a transaction for a new house and secure a fixed loan rate. It's important to note that mortgage rates are closely tied to interest rates and often change in response to the yield on domestic 10-year Treasury notes. In light of the current situation where employers are not returning to work, there have been significant implications for sectors such as real estate investment trusts, REITs. REITs own office buildings, and with the uncertainties surrounding the return-to-work scenario, the real estate market has faced challenges. Additionally, the Federal Reserve has had to make decisions while dealing with a $30 trillion debt on the balance sheet and an estimated $200 trillion off balance sheet. The Fed has been implementing interest rate cuts, but it raises the question of whether this cycle will come to an end. Credit card debt is another area where interest rates have a direct impact on personal finances. When the Fed raises interest rates, credit card companies may increase their annual percentage rates, APRs, making it more expensive for individuals to carry balances on their credit cards. This can result in higher monthly interest charges and longer repayment periods, making it more challenging for individuals to pay off their credit card debt. Investing in precious metals like gold and silver is often considered an excellent way to hedge against inflation and economic uncertainty. These metals have been used as currency for centuries and are highly valued for their rarity, durability, and aesthetic appeal. Unlike fiat currency, which can lose its value due to inflation, precious metals tend to retain their value over time. Robert Kiyosaki is a strong advocate of investing in precious metals as a means of preserving wealth. According to him, keeping money in a bank account or other low-yield investments is not enough to protect oneself against inflation. Instead, Kiyosaki recommends allocating a portion of one's portfolio to precious metals, such as gold and silver. Historically, gold and silver have held their value remarkably well over time. For example, in 1971, the price of gold was $40 per ounce, and today it is over $1,700 per ounce. This shows the long-term stability and value of investing in gold. Silver, too, has had significant price increases, from around $1.30 per ounce in the early 1970s to over $28 per ounce in 2023. Moreover, precious metals have historically been an excellent hedge against economic downturns and inflation. During times of economic uncertainty, such as the 2008 financial crisis, the price of gold and silver often increases as investors seek a safe haven for their money. Therefore, investing in precious metals can offer both a safeguard against inflation and a potential profit opportunity during market turmoil. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well.